Bank of Canada surprised many economists earlier this month when it cut its interest rate by 0.25%. The move came after a recent slide in oil prices that caused a crisis of confidence in the Canadian economy. But will an interest rate cut make any difference at this point? Kristiaan has more from Toronto.
Drivers may be cheering the news of cheaper oil. The price at the pumps hasn't looked this good in years. But for Canadian economists and those connected to the energy industry, these are worrying times.
The drop in oil prices is unambiguously negative for the Canadian economy. Canada's income from oil exports will be reduced, and investment and employment in the energy sector are already being cut.
The Bank of Canada surprised the market by a 0.25% cut to 0.75%, the first interest rate adjustment since 2009. This, Governor Stephen Poloz says, should help offset the instability caused by oil losing 60% of its value in just 6 months. For Canada, cheap oil means energy sector cutbacks and less government revenue. Energy accounts for a quarter of all Canadian exports. On the flip side, Canadians will be spending less on their energy, their mortgages and loans, and with stronger growth in the US and a weaker Canadian dollar, Canada's non-energy exports should see a boost.
The rest of our exports that are not energy related, now all of a sudden they're much more competitive on global marketplaces, so that gives a lift to obviously those exports, and it also gives a lift to household sectors where now their debt burdens are a bit more manageable. They might have a little bit more spending, especially since they're saving on gasoline prices as well.
For years, the energy industry has delivered jobs and growth for Canada, but those days are over for now at least. In cutting interest rates, the Bank of Canada has hit the emergency button and is hoping that its surprise measure will steer the country away from further economic turmoil. Kristiaan, CCTV, Toronto.